Welcome back to week 2 of the Online Investor's Guide to Thriving. Online because, as many of you know, we typically do these events in a cross-Canada tour with live sessions in each major city. Now, when we do live events, we get to deliver exactly the same talk in each city. The audience is completely different each night, so you only have to write one good joke and tell it 12 or 14 times. Results vary by province. So, the challenge here is to keep things fresh when a strong majority of the audience is the same as last week. Meeting that challenge is a world short on masks and toilet paper, but overflowing with news and market volatility. This afternoon, I attended a webinar with one of my favorite neuropsychologists, specializing in how people think about money. She shared 2 models for how people cope with threats. You have a group called monitors. They want as much information as possible about the threat, and blunters, as the name implies, would prefer less information. We have over 4,000 people on this webinar. Chances are, if you're here, you're most likely a monitor. Here's a sure way to tell. If you check your portfolio value more than once a day, you're a monitor. Now, a monitor may feel that a blunter is actually sticking their head in the sand at their own peril, but perhaps they shouldn't be so quick to judge. In healthcare, the debate is ongoing as to whether monitors have better outcomes by being more proactive. In the investment world, Daniel Kahneman's work suggests blunters fare better more often. All the information can make monitors uneasy. The stress and fixation leads to a functional drop in IQ available for decision-making, which can exceed 15 points. Essentially, they make worse decisions. We're seeing a live experiment play out week to week on this webinar series. The questions coming in suggest a significant number of attendees here are hoping to time the market lows. Another behavioral bias, anchoring, comes into play. Many of you will probably remember last week, Larry mentioned 1,500 as a potential low point for the S&P 500, but few will probably remember his nuanced plan to adapt to the range of possible outcomes. Because no one knows what will happen, the big number or the scary number stands out. Some think, surely I can just step aside and wait for the market to go there, and then swoop in and buy like a genius at just the right moment, maybe within a few percent of the right moment. Folks, that's wishful thinking. So is predicting which specific companies will knock it out of the park as markets recover. I thought Boeing was a great deal after it was beat up over the 737 MAX. Fortunately, when it comes to investments, I tend to be a blunter. I did nothing instead and left all our money in our balanced funds. Boeing on sale in December doesn't seem quite as compelling today. My point is, I hope we're reinforcing that timing the markets is unlikely to be successful. Instead, we focus on taming the markets, getting the fit right for each person, optimizing portfolios for diversification and for protection, while also allowing for growth when the markets surprise us to the upside. Much of what Larry does cannot be done by the average DIY investor, but hopefully we're showing you how to think strategically and tactically to have the best possible outcomes with your money. This is the second in an ongoing series of webinars, every Thursday at 7 p.m. Eastern through the end of April. Each week, we'll try to help you think more clearly about the world. For those who want to catch the webinar replay or download Larry's slides, tomorrow morning you'll get a short email survey. Tell us how we did this week, and you'll get a link to access all of the above and submit questions for next time. If you need a little help navigating markets and financial life in general, Larry and I founded ETF Capital Management to provide portfolio services to clients with a need to manage $1 million and up. We've partnered with BMO to offer ETFs and funds of ETFs for those currently working on their first million. We also came together with Monique Madden to bring Canadians U Potential, a professional fee-for-service with a planning-only mandate. Investor's Guide to Thriving comes at no cost to you in favor of 2 causes that Larry and I believe in passionately: sick kids and the Baycrest Foundations. We're aware that last week some folks tried to make donations to sick kids and experienced issues with the online form. Those issues are now resolved, so we hope you can join Larry and I in supporting childhood leukemia research at sick kids. We also appreciate your support for the groundbreaking work being done by the Baycrest Foundation into the treatment of Alzheimer's and dementia. For those of you who have made donations, thank you so much. For those who would like to make donations, please use the links you'll receive after the event. Thank you also to our sponsors, National Bank Direct Brokerage and BMO ETFs. BMO ETFs was the first, and to date the largest supporter of Investor's Guide to Thriving. A great partner in ETF education, we've been constantly impressed with the high quality of resources they make available to investors. Speaking of a great resource for investors, it's my pleasure to introduce Erica Toth from BMO ETFs.
Thank you so much, Jared, and thanks for having me on the show. So first of all, I want to open up by saying thank you all for your support over the last decade. In 2009, BMO actually celebrated 10 years since we've launched our ETF division and celebrated last year 9 years in a row of being the top-selling ETF provider in Canada. So BMO's brought a lot of innovation to the ETF marketplace in Canada, being the largest provider of fixed income ETFs, the largest provider of smart beta ETFs, which would include dividends, low volatility, and high quality, the largest provider of covered call ETFs, and the largest provider of managed ETF funds. Now, Larry is, of course, running 3 of those funds, and those are also known as the Sleep at Night portfolios, the Tactical Dividend, the Tactical Balanced, and the Tactical Global Growth Mandate, which represent over $1 billion in assets. So as Jared just mentioned, BMO ETFs has actually invested a significant amount of time and resources over the last decade, putting together top-notch educational materials, which I'm going to discuss towards the end of my introduction. But to open it up, I just want to give you guys a reminder of one of the main benefits that ETFs offer to investors, and that's liquidity. Over the extremely volatile markets we've witnessed over the last month, this has been a testament to that key benefit. So as a little reminder, there are 2 layers of liquidity to an ETF. The first layer represents the exchange and the market maker. So this first layer of liquidity is always there for you to get in and out of the ETF. So you can trade at any time during trading hours. The second layer of liquidity is between the market maker and the ETF provider. So this is where the creation and redemption of units happens, depending on the amount of supply or demand in the market. So even in times of market stress, you're still able, sorry, if we don't mind just going back to that slide for a second, I do want to make a little point about the way things have been trading over the month of March. So even in times of market stress, you're still able to trade the ETF. So real life example, 2 black swans hit the market in the month of March. So we're talking about COVID-19, of course, and the oil shock. So what happened is that credit spreads blew out and the bond market completely froze. So corporate bonds in Canada and in the US and many provincial bonds in Canada went no bid, or in other words, they stopped trading. The entire bond market was actually inhibited until the Fed stepped in. So a large part of the bond market was not trading, but ETFs were. ETFs provided price discovery and liquidity during this time of market tumult. The prices that bond ETFs were trading at were below their NAVs, or net asset values, because the NAVs for ETFs and mutual funds alike were stale and too high because they're actually based on the pricing of bonds that had not traded in a few trading sessions. So ETF pricing in this type of a market was actually more reflective of actual market conditions. So just a little reminder, we have put together a PDF of trading best practices for ETFs. So I'm just going to go over a couple of quick reminders, and these apply especially when markets are volatile. We always advise to avoid trading on the open and on the close, so the first and last 10 minutes of every trading day. So this allows enough time for the underlying portfolio to start trading, and the markets can be quite a bit more volatile at the open and at the close. That's why we always advise to avoid trading right on the open and on the close. Also, to always use limit orders, because the entry or the exit price of your trade will impact, of course, your overall profitability. And with a limit order, you know exactly what you're getting. In a fast-moving market, like we've seen over the last few weeks, you might have to update your limit price. We always suggest to also trade when the underlying market is open, if possible. And that's when the bid-ask spreads are going to be the tightest. And where possible for international ETFs, always to try and trade when the underlying market is open, and keep in mind any sort of holidays where those other markets might be closed. So another just quick reminder before we move on to the next slide, that during times of high market volatility, it is normal for bid-ask spreads to widen out and they can change very quickly. So this is another reason why it's important to always use limit orders to ensure that you're getting the best price and the best fill possible. So just moving on to the next slide now, I want to touch on the impact of currency. So as a Canadian investor, when you're investing in US or international securities, there are two components to your returns that you need to be aware of. So the first component is the return of the actual basket of securities. Let's say if you're buying the S&P 500, it's those 500 US stocks, the return of those stocks. The second component is the return of the foreign currency, in this case the US dollar, versus the Canadian dollar. BMO and also other ETF providers increasingly offer both a currency hedged option, which is just the returns of the stocks, and an unhedged version, which is the returns of the stocks plus the returns of the foreign currency versus the Canadian dollar. So if you think that foreign currency will appreciate versus the Canadian dollar, you would then buy the unhedged version of the ETF. If you think that the Canadian dollar is going to strengthen versus the foreign currency, you would buy the hedged to Canadian dollar version. Now, one of the common approaches used by institutional investors is to do a partial hedge. So they would buy, let's say, half of the position in a hedged to Canadian dollar version, and the other half they would leave it unhedged. So that way on, you only participate on the currency movement on half of the portfolio. So I just wanted to mention that as, you know, Canadian dollar hit a low of 68 cents a couple of weeks ago. Now we're holding around in the 70-cent range. So there's been more questions around currency hedging, which I'm sure Larry will address shortly. So on the next slide, Jared, you had mentioned going to cash. Now, this is probably the hardest call to ever get right. And I've included a slide up here to illustrate. The challenge with going to cash is it's really difficult to know when to get back in. So the chart here, of course, shows 2008, and now we've updated it to include COVID in March. So the example here is of someone who got out of the market after the drop in 2008 and waited exactly 1 year before going back into the market. So that's what that red line represents. So even after a decade of strong market returns, that individual never caught up to those that stayed invested, even after today. So these are trade-offs that you have to think about. It's your call, obviously, but you need to understand that after 2008, the biggest lift in the market was that first leg back up in March of 2009. So Larry's going to come back to that a little bit later on. So I wanted to mention BMO ETFs is partnering with the TMX to bring you a number of market insights educational webinars. The dates and times are listed on the screen here. And I know that since everybody is staying at home, none of you have any plans anymore. So this could be a good opportunity to get further educated on ETFs and on the market. So lastly, just to close it out here, I want to just give you a little reminder of some of the great tools and educational resources that are available to ETF investors. So I'd like to point out our ETF website, which is bmoetfs.com. So if you want details on any one of our particular ETFs, you could access holdings, performance, tax, and distribution information. That's bmoetfs.com. But what I have up on the screen here is bmoetfs.ca. And that's a standalone separate website. That's the Canadian ETF dashboard. So if you're a huge nerd like me and you like to go super in depth and read up as much as you can about the markets, this would be a site definitely to check out. So we're giving now timely insights on the markets, trade ideas, information on ETF flows by not only by provider, but also by asset class and by product. There's updates on the products, and we've even added podcasts now. And of course, there's the ETF comparison and screening tools. So you can pick up on the ETF comparison tool, by the way. You can compare up to 5 ETFs or mutual funds from any provider in Canada. And on the screening tool, you can put in your investment criteria and it'll give you a short list of ETFs that correspond to your investment criteria, both from BMO ETFs and from other providers. So I'll leave it off with that. I thank you again very much for having me on the show. And with that, I'll hand it over to Larry.
Thank you very much, Erica. Okay, navigating the storm that caught us all by surprise. Listen, folks. I don't know where things are going. Jared mentioned trading ranges. Where's the market going to bottom? A lot of questions are coming in, and so I'll get to all the questions. I may answer a lot of them in the conversation we're going to have tonight. For those of you who tuned in last week, similar presentation. I've got a handful of new slides and a couple new interesting points to make, and it'll all be in context of the current environment. So, as I noted last week, one of the things that's kept me up at night and why I've been so concerned about the markets for years now is that we have not seen an increase in corporate profits. So this data comes from the Federal Reserve database, and they're looking at the data that comes out of the National Income Accounting from the U.S., out of the U.S. Bureau of Economic Analysis, and you can see that we had strong earnings growth and revenue growth in the 2000 swing. We had strong growth in the 1990s. But really, since 2012, we've had no growth. And all the growth in the marketplace has been largely shenanigans, financial engineering, low interest rates, all these things that have pushed markets higher and expanded the multiple, and not because the economy's strong, not because earnings are growing. And it's very disturbing to me. So as COVID-19 has revealed that the emperor does indeed have a unusual wardrobe, it's what shocks like this says where's all the leverage hiding? Okay, so we're finding out where all the leverage is hiding, which funds are blowing up. Where's the financial fraud? There was a company today that was down 70 or 80% or something like that because they finally admitted that Muddy Waters Research or Citron Research had been correct in saying they were committing a fraud. It was a LMK, some coffee company. I can't remember the name of it. In any case, we saw this when the dot-com bubble burst and WorldCom went bad, and we saw this with the bad housing lending in the banks a decade ago, and so this time around we're going to see where the garbage is, and where the bad balance sheets are, and it's going to just take some months here for this to play out. The idea of a V bottom. And this thing recovering really quickly, to me, is a naive view. So, understanding market volatility and tail risk is really important. But what you need to understand is, when I talk about sleep at night portfolios, I'm talking about minimizing this tail risk, not eliminating any risk at all. And so it's okay to have volatility. That's what investing is about. Nobody can time markets. And I just saw a study today that came out where they looked at last year's portfolio managers. So they take all the managers that manage US equity funds, large cap, mid cap, small cap, and the vast majority of fund managers don't beat the index. And it's year after year after year after year, and the data's so long, yet people get, it's kind of sexy trying to buy the right stock and right industry and try to win and beat the market and get big returns. But what I do is not that. I concentrate on being diversified. I concentrate on missing or reducing the fat tails, the events that we can't forecast. Now, you can never run a portfolio that's really going to eliminate all these things. Like, you just can't. It's a naive assumption. So when I talk about sleep at night, this is what I'm doing in the portfolios, so that the day-to-day return, the standard deviation of the day-to-day moves in the sleep at night dividend fund is actually, over the 6+ years now we've been running it, 0.48%. compared to the world benchmark, Vanguard Total World ETF of 0.83. And so how it shows up statistically is that we have lower tails. They're not as fat. We don't get as much volatility, because simply what we're trying to do in this portfolio and in all the portfolios I run, and I'll talk about a couple of the other ones here that you guys have access to, and that is to deliver a higher average return with less volatility, because it's the volatility that creates all the anxiety for people, both on the upside and the downside, folks. There's awards given out in the industry for people who are the best at this, and two of them that I've won for this fund. One's called the Lipper Award, and it's given to funds with the best risk-adjusted returns compared to their peers. So other funds focused on balance and dividends. And then the A+ award was very similar. So when I compare what we've done in the BMO Tactical Dividend Fund, the orange line here, with just a buy and hold equivalent. So the iShares Global Monthly Dividend Index ETF CAD hedged. And that ETF, you can see in the green box here, has a standard deviation of around 18% compared to mine, which is closer to 10, almost half. So I've got half the risk and volatility, and I've got way more return. And so this is the snapshot of that compared to the Canadian dividend basket. So as of a couple of days ago, literally, if you just bought ZDV, and folks, this is a great ETF. This is a basket of all the best dividend paying stocks in Canada, including the banks and insurance companies. And who doesn't want to own those? But from 2013 till today, you've made no money if you just bought and held. So while I like passive investing by way of ETFs, I like them for their tactical asset allocation ability. And when I think the risk factors are high, I just take less risk. And so what that meant in the last few months, you can see the orange line there ducked well below the white line. Because if you didn't care about risk, the fear of missing out compelled you to get invested, because that's what the narrative was. But I had been looking back for years saying, geez, there's not a lot of growth here. There's way more risk factors. But because since 2013 there's been no earnings, it doesn't mean I haven't made any money. We've made an annualized return after this most recent drawdown of 4.39%, including all costs. But you compare that to the Canadian basket and, of course, the global basket. So you always got to look at apples to apples when you compare. And there's been some criticism pushed on me recently because the tactical dividend fund this year is down 13 or 14%, and people are saying, well, that's not sleep at night, Larry. And to those people, I think you're taking a naive approach. Those people who think they can be all out or all in and time the market perfectly are going to not have the experience ultimately they really could have. But there's two other funds we run, and with recent changes in the rules, you can now buy the D-class fund, and it is a mutual fund, it's not an ETF. And the ticker, the fund symbol is BMO 31762. And it's the same cost as if it were trading by MER basis as the tactical dividend fund. It's about 70, 75 basis points. And here again, what we're trying to do is deliver the experience of a traditional growth fund. So the Vanguard Total World ETF, VT, or a low volatility version of the world. So the ACWV, which is the MSCI All World Global Low Vol ETF. And you can see as we compare to both of those, we've got a higher average return with less standard deviation. So whether it's growth you need, whether it's dividends you need, or whether it's more balanced and you're a more conservative investor, we've got a strategy that the users, the followers of mine, and the do-it-yourself crowd can actually. And the benchmark for these are simply a traditional balanced portfolio. XBAL, BMO has ZBAL, I think Vanguard has ZBAL. And so it's your traditional 60-40 balance type exposure. So let's have a look at what that's done since we launched the Balance Fund in 2015. And sure enough, if we look at it, you might not be happy with a 3.19% average return, but that's the buy and hold return, or sorry, 1.77. That's the buy and hold return of a globally diversified 60% equity, 40% balanced portfolio. And what have we done? Well, it was ahead of us the last few months, but you can see during the bad periods that we go down a lot less and we tend to protect. And over time, we generate that higher average return with lower standard deviation. So when we look at the three funds this year with their relative benchmarks, this was similar to a chart I had today on BNN. You can see that my balance fund is barely down. You know, that's pretty darn good. Now, if you compare that to the benchmark, you can look at the benchmark. So the balance fund, the red line, the benchmark for that is the yellow line, and that one's down around 12%. So when you look at that, you say, well, your balanced portfolio buy and hold is down 12, and your active portfolio is down about 2%, 1.87. You can see that in the total return in the table above. Well, what about the growth fund? Well, the growth fund is down 6.34%, and isn't that terrible because you're down? Well, this is the worst bear market, folks, since the Great Depression that we're heading into. And so the buy and hold global benchmark's down 25.5%. But how about global dividends? So yeah, Larry, you're down 14%. Isn't that terrible? Well, the benchmark is down almost 32%. So you got to look at the relative benchmark when you're comparing these things. But we've been delivering for years and years and years now, folks. And when you call in and ask a question, and when you ask questions, I'm giving you my advice on what I would do in my portfolios. Okay, so what I've been saying recently, and I talked about this on the show a few weeks ago, is I'm using the playbook from the worst financial crisis in our era, and that was what happened after the housing bubble burst a decade ago, more than a decade ago now. So the blue line here is the VIX index. And what we learned from that experience is that through the uncertainty, so if this has just started, there's months and months and months of uncertainty ahead of us. What's the hit to earnings going to be? What's the economic impact going to be? We're debating, is it a V bottom? Is it a U economy? Is it an L economy where you go down and you don't come back? Or is it a U where you go down and it takes a longer time to come back? Or the traditional V, the down and right back. Well, investors have been conditioned market-wise for lots of V's over every dip we've had in the last 11 years of this record expansion has been a V. It's been down for a month or two and then right back. This is the worst financial crisis. This is globally since the Great Depression, folks. It ain't coming back right away. So this is a very good playbook to understand what volatility is going to do and what that might mean for price. So we've got our candlestick chart of the S&P 500 here from the August period through the bottom in March of 2009, and what VIX did. And it wasn't until the volatility index dropped well below 40 for a couple of weeks before the bottom, but you could be convinced that the bottom was in. And so this is just starting, okay? But tomorrow there could be a cure. There could be something where this is all mitigated and we all go back to work. And that's the thing we don't know. We don't know. And you guys asked me, where's the bottom? What's the level? Folks, I don't know. What I do know is we're going to get a headline, and it's going to be that there's a cure, and within 3 weeks, the world goes back to work. Now, there's going to be still an economic aftershock. Do you think the 10 million people that in the last 2 weeks in the US and the million in Canada and the million in the UK that have got laid off, do you think they're all getting their jobs back? No, corporations are going to rationalize, and they're going to downsize, and they're going to cut, and they're going to slash, because they all have uncertainty in front of them. So that phase of the cycle is still coming. And who knows when it's going to end, right? So this is a good playbook, and you got to understand how VIX works. So a VIX of 10 is a standard deviation daily of 0.63. And remember, in the Sleep at Night Dividend Fund, I showed you my daily volatility is 0.48. So I'm running a portfolio with a volatility lower than the VIX, lower than 10. Okay, that's what it means. And so a weekly range of 1.4 would be the equivalent of a 10 VIX. VIX right now is in the 50 to 60 range, has been for the last week or so, spiked to 80 recently, and that's what those numbers mean. If you want to calculate the expected volatility based on the VIX, I've given you the formula there, okay? So let's go to understanding fear and greed. A question already came in on the question and answers. How long do we wait where we've got a lot of greed or a lot of fear before we get back in the case of fear? And again, the answer, folks, I don't know. There's no rule that says if it gets to this level, do that. Because folks, if there was that rule, I wouldn't tell anybody and I'd have all the money in the world, right? So stuff like that just doesn't exist. There's no one thing you can do. The bottom at the end of Q4 2018, when we were about the Fed tightening and trade wars, look at how those indicators played out in that environment. How about when the VIX indexes had a major explosion at the first part of 2018? Look at that bottom, how it played out. There was a dip in 2017. It was very shallow, very brief. In fact, in 2017, even though some of these indicators swung, we did not have a 3% correction in the S&P 500. The last time we went through a calendar year without a 3% correction was 50 years ago. So 2017 was an anomaly. What's more normal is volatility swings. And because of free money and easy policy and lots of leverage, creating lots of band-aids, covering up lots of bad deeds corporations have been doing that are now going to come to the surface, the market vol has been suppressed. But folks, that's more artificial. What's going on now is extreme the other way. We'll normalize eventually. But VIX in a normal situation, 15 to 20. That's a normal long-term range for VIX. When it's below 4, when it's closer to 10, you know that there's going to be something coming that's going to upset the markets. You just can't time it. So this indicator, the fear and greed index, and I'm working on making one of these for Berman's Call. We're going to have a Berman's Call, and it's going to be slightly different than this, but the elements of this is looking at VIX and its relationship to its 3-month average, 50-day average, we'll call it, the put-call ratio, what the speculators are doing in the option market, because leverage goes to options, so it's important to track what those people are thinking. Market breadth, how many stocks are going up and going down, and how much volume is going up and going down, and the best in that regard are the McClellan series of indicators. The differential of returns between stocks and bonds. When you get a surge in stocks and bonds sell off aggressively, you're going to get some mean reversion, or you get a rebalancing in portfolios. How many stocks are making new highs versus new lows? The spread between crappy bonds, junk bonds, JNK as an ETF or HYG, versus the investment grade, high quality corporate bonds. Now, both of those spreads blew out dramatically versus government bonds in this most recent move. And then what's the stock market doing? What's the S&P 500 doing relative to its 6-month average? Okay, 125 trading days, 252 in a year is a 6-month average. And so are we way above it or are we way below it? And that's what the money indicator is. There's the ticker for it if you don't know it. But you can go to the website. All the charts are there for all the individual indicators. Folks, when we are in a period of extreme greed, what you must do to your portfolio is take less risk. It is not the time to buy your favorite tech stocks. It's the time to buy your favorite utilities, okay, that will give you a good dividend and protect you. And then when you're in an environment like we are now where extreme fear is present, this is where the shopping list comes out and you want to put money to work. But again, I'm emphasizing I don't know what day that's going to be, what week that's going to be, but I do know we're in the environment where you want to look to buy things, not necessarily sell things. So where's the bottom going to be in earnings? Because for me, that's the next phase of the cycle. And what we talked about last week was you looked at a chart like this, and now I've updated it for the last couple of days here of trading. But when earnings took the hit in 2008 and 9, I mean, it fell. So the blue line is trailing earnings, and the dotted black line is analyst forward expectations. And you can still see today, based on a couple of days ago, and it's not materially different today, or I would have changed the chart, that expectations for earnings, folks, today is still higher than trailing earnings. So the analysts on Wall Street collectively believe that we are going to have a V bottom, and that is so misguided, I can't tell you. But I remember vividly the same commentary as things were coming unglued early in 2008 and Bear Stearns went bankrupt. All the analysts were still very positive. Look, in fact, their forecasts are always above trailing earnings. But the markets didn't bottom, that green vertical there. The markets bottomed when finally their forecast of earnings dipped below actual earnings in the bank. Now, earnings kept falling for the rest of 2009, and we didn't recover in earnings. So the Lehman moment, I have it highlighted there at the low red dash, the low red arrow. That was from the Lehman moment until earnings recovered from the Lehman moment. But earnings had been falling well before the Lehman moment, as you can see there on the blue line. And it took almost 4 years to recover earnings from the previous peak. So that just tells you a little bit about what to expect on the fundamental side. If you think we're going back to a 20 times multiple anytime soon, you got to have your head examined. I don't have a nicer way of saying it. So where's the bottom going to be? I don't think, because of all the liquidity that's already been provided, that we're going to go back to the worst of the 2008 and 09. And that was $60 in earnings with an 11 multiple, giving us a low in the S&P of 666. I don't think that's going to be what plays out here. And at the peak, we were at 3,400. Today, we're around 2,500 when I printed this out as of the close yesterday. Today, we're a little bit up from that. So at 2,500, approximately, the multiple was 16.7. So if you look at the graphic here that I pulled off the Bloomberg terminal as of yesterday's close, it showed for a value of 2470.50 for the S&P 500 and what analysts are expecting for earnings. So look at what the actual is for the current quarter we just came through. The quarter estimate one, so they're expecting about a 10% hit to earnings for this quarter. But then 1 quarter out, they're expecting it to rebound. These guys are nuts. There's no other way of saying it. And 2 quarters from now, earnings are going to continue to grow. So the forward 12-month estimate, earnings in the bank are 150, 170. We've earned that. The market owns that. They still think earnings are growing a year from now. These guys are absolutely insane. So when you hear a portfolio manager coming on TV and say the forward multiple, so they look at the F12 and then the year plus one, a year, it's the market's cheap. It's not, because that is the wrong earnings number to base this off of. So what is that real earnings number? Well, 20%, okay, of the earnings in the bank, 10% of them been created artificially by share buybacks. And folks, for years to come, that game is over. 10% has been non-GAAP pro forma BS earnings. They're not going to be able to get away with those same BS earnings. And this is what I was talking about at the outset, where a lot of the stink that's been put under the rug is going to be revealed as we go through. Now, there's a very good chance that Q2 earnings that we'll start hearing about in July and August are going to be kitchen sink quarters. And that is all the crap that companies have been hiding for years is going to come out, and they'll get forgiveness. So we'll get a kitchen sink quarter. But that to me means earnings for Q2 is not 2 quarters from now, is not $40. It's going to be $30. So, and then we're going to work off that base of recovery at a minimum. So if we're quarterly now based off 30, that takes us to 120 in earnings, okay? So if we look at 120 in earnings, and we say, well, what does that get us in terms of the multiple? That's where you look at, a 16 multiple times 120 gives you 17 or 1920 on the S&P. So for me, somewhere just below 2,000 is the very minimum where I'm willing to start putting a lot of money to risk. Okay, and bringing out my shopping list. Are we going to get there? I don't know, because if there's a COVID-19 cure for this tomorrow, we may not see those numbers. We may still, but we may not, right? So that's the tough part of a market like this. If you think you can be all out and time it when you get back in. Now, we're going to have some rip-roaring rallies, right? We really are going to have some rip-roaring rallies here. So, where are they going to come from? Well, we're going to have one for sure when the state of New York says we've hit peak virus, meaning they're not adding new cases. They're starting to, more people are leaving hospitals. So where's that curve? So here's came off a firm that I follow out of the States called GMI. And based on projections, scientific, this is not Donald Trump stuff. This is scientific projections from Johns Hopkins University Medical. They're saying somewhere around mid-month. Now, I heard Governor Cuomo today say that target has now been moved out to the end of April, peak virus. So we're in an environment where, listen, all the science doesn't even know. And what Anthony Fauci says when he comes on the news every night and he stands there next to the president says, the virus is going to tell us. All the webinars I've watched, all these epidemiologists says, we don't know. The virus will tell us when it's over. So the best we can do is mitigate and stay safe and not spread and do all the things we need to do. So technically, there's a bunch of targets. Jared, I mentioned the old highs from 2007 and 2000. And so here's the chart. And you can see the line there. Is that going to be good support? Is that where the bottom is? Are we going to even get there? Right? Now, I got to think when we look at some of the other colossal bear markets in history, that were 40 or 50% haircuts, 50% takes us down from 3,400 to 1,700. It turns out technically that the Fibonacci retracement is 1,708. So I like the probability of 1,708 better than I like the probability of 1,550 to 1,575. But maybe it's only 50% of the bull market. And so 2030 is the bottom. So do you see where I'm going here, folks? We don't know. And so what we do is we step in, we leg in. And each kind of notch the market takes lower, we put a little money to work. But you got to be okay with it. You don't want to buy something at 20 and have it go to 18 and sell it on something that you know, if you didn't look at prices, a year, 2 years, 5 years from now is going to be worth $25, $30, or $40. So you buy a bit at 20, you buy a bit at 18, you buy a bit at 16. And if it doesn't go that low, at least you got some money in. Okay? So that's how you have to think about it. And that's what I do. And that's what we do for our clients, because nobody really knows where the bottom is going to be. Now, when I'm nervous and when I want, people say, well, go to cash. Well, you go to cash, but cash pays nothing. And you can certainly use bonds, but bonds yield pretty much nothing these days after. So cash and bonds for a long time are going to be impaired. Now, cash is safe. You got your money. So there's that element, but you got no yield. So if you're the kind of person that needs your savings for your income, well, you're not working anymore, and you need that to generate a yield, then you got to put it at risk, meaning bonds, corporate bonds, dividend paying stocks. So there's some issues there. So there's ETFs like this that allow you to invest, still get a return on your money, but you got to do it at the right time. So I like these alternative type investments, but I don't like them all the time. I don't have any now because the markets have already reset for me. I was buying AGFIQ anti-beta fund in January when I was worried about valuations. I didn't know COVID was going to do this. I had a sense that we needed to do social distancing. I talked about it on a show in February, but I had no idea that the world would fall apart so quickly and the entire world would shut in and borders would close. I suppose if I thought about it, that could have been a risk, but wow, how fast has it happened? So it's pretty incredible. But here's an ETF that's long, low beta stocks, short, high beta stocks, and so has a negative beta, and typically will do well when markets are weak. So you got to know your products, and you got to know what's out there beyond generic ETFs. I think it's essential when it gets to points of high risk. So again, when the CNN fear and greed indicator is saying, don't be a pig, find investments that are going to allow you to sleep at night better. It's that simple. So here's another ETF series that I like. So Purpose ETFs a number of years ago came out with PYF. And PYF is they call it a premium yield fund. It writes puts and buys stocks when you get put, and then it writes a call. And so I said to BMO, I said, great product, I want more of it. The Purpose ETF isn't big enough for me to buy enough of it, so make one for me, and they went and did. I actually like the way BMO runs theirs a bit better than Purpose, but they're both very good products. And so you can see how ZWH and the total world index. So if you're bullish, just buy the world, you'll get all the upside. But when you're concerned, you want an ETF or a holding that goes down less. So the high dividend covered call, you got covered calls. You're getting extra yield, but you're giving up the upside. In the Purpose, look, you got no upside, but you got a pretty steady eddy for 5%, and it went down way less. And you just have to be okay with that, because you're investing for the yield. You need the distribution to live off of. So you got to understand some of these products and how to use that. But once we've had the average correction, so in non-recessionary times, the average correction 13.5%. In recessionary times, the average correction 29%. We are in recessionary times. We've already had that minimum correction. However, this is the worst economic hit since the Great Depression. You got to think it's going to be worse, especially since we started with a market that was extremely overvalued. Okay, so far we've only taken off the froth of overvaluation, and I showed you that on the multiple. 16 is the long-term fair value multiple. Some people will argue it should be 18 because of low interest rates, and okay, so let's call it 18. So there's a product is a market neutral. So what the smart people that are running this fund are doing are saying, I like Royal Bank, I don't like Scotiabank. And so they're long Royal and short Scotia, and they've got 50 different pair trades they have on. And look, in a bad market, they can make money too. So again, you don't want this in a bull market because you're net market neutral. You're relying on the manager's skill of picking a good versus bad. And you want that in an environment like this. You don't want that in an environment where there's low risk. And so you want all the upside you can get, more exposure to open markets. And these are some of my favorite. Folks, I do this in my portfolios in my private client business. We've been using options strategies. And what we can do is so our growth fund this year in our private client platform is down about 6%. And so how does a growth fund down fully invested down 6%? It's because we use option strategies, not unlike what they do in these ETFs. Where you can buy these buffers. So the buffer ETF buffers 9% of the downside. And I got a question actually today on the show about these. The 15% buffer, and then there's the 5 to 30% buffer. And all of them allow you to get upside. So if you're concerned about the market, these are good to go into. Okay? Or what I do when I'm concerned about valuation is I buy a put spread. So I can buy a 9% put spread. So I would buy an at the money put for the S&P 500 and sell a put 9% below the market and know that I'm protected for 9%, but there's a cost to that put, that spread. It's going to cost me money to buy that. To pay for that, to make the trade free, I'm going to sell a call. So I'm going to sell my upside away at a price that fully pays for that put spread. And so typically when you look out a year, so this is last April, so they issued these April 1st, a year ago, and this is the behavior of those ETFs. And what you can see here now is the ones with the 9% buffer, they're down around 7 or 8% compared to the full on market SPY, the red line that's now down 20 something. So the buffers are working. Okay, the buffers give you buffer. The yellow line there, which is the ultra buffer, that one says you're going to lose the first 5%, but you're protected on the next 30. So it's currently down about 6% as of the 22nd, and the options expire on April 1st, so it would have expired. So that buffer ETF in that year went up a maximum of, you can see that again, that dotted yellow line, a maximum of about 8%, but then it only lost 5 when things came unglued. Okay, so go educate yourself on these. I've been using these for my clients to protect their portfolios. And this is something that if you learn to understand how to hedge your risk with options, you can use these. If they're too complicated, folks, there's ETFs for that. And if you don't understand the ETFs, by all means, please give us a call in our office. We're very happy to customize portfolios for individuals. So before we go to the Q&A, I want to talk about my shopping list. It's the same shopping list as last week. I haven't added to that. I talked about a few different ETFs on today's show that aren't on this list. Parts of the world where there's young populations. So 2 ETFs were India and frontier markets. Frontier markets are a lot of these dark bluish purple areas, sub-Saharan Africa, parts of the Middle East, and India. where the average age of the population and the population growth is going to come from. The US is going to grow, but it's largely going to grow through immigration. Same with Canada. The average woman in Canada is 40 years old. Guess what? At that age, women on average aren't having any more kids. So the demographics matter. The two ways that I think we can service the demographics are through technology. So global technology solutions, I think, are going to be big, and that's one sleeve. And then those countries themselves that have very young populations and can really benefit from some of these as the next wave as we come out of this. So lots of different things on the shopping list. I want to leave time for questions here. So let's get to the prepared questions. So the people who have emailed in, I'm going to answer a bunch of those first, and then I'll get to as many as I possibly can in the people who have written in online here. So they said, I always invest in GLD and SLV. Those are the gold and silver bullion ETFs. And my understanding is they don't hold 100% physical. That's true. Most of these ETFs will hold somewhere between 75 and 80% physical, and the rest being in certificate form. And the reason they do that is because as units are created and redeemed, they don't want to take the physical gold and move it from their vault to the vault of the guy who just bought that in Switzerland because he wants to take delivery. So that doesn't work. Okay, so they use the certificates. So basically it's a paper trade. And so the criticism here in this email is that, but I want to actually own gold. Folks, you own gold. Okay, I gotta debate this with everybody. These are perfectly adequate for investing in gold and silver. Now, Billy asked if there's another one, and I would say have a look at MNT in Canada, done by the Canadian Mint. Those are full bullion backed if you want to look at something like that. But folks, if you're worried about Mad Max, if you're worried about the system collapsing and you want gold bars in that scenario, folks, are worth nothing. You want canned goods, you want soybeans, and you want a shotgun. Because I'm not trading you any one of those three for a gold bar that I can't eat. So those are my thoughts on the difference between physical gold and gold proxies and ETFs. Okay. Brent asked, would I suggest an ETF that investors sell their unhedged TSX and US index funds to buy a hedge version based on the currency? So Erica talked about those at the outset of the show today. You have to have a view on the Canadian dollar. And so long term, I think the Canadian dollar, with all the challenges we have here in Canada and the US and everything else, probably is between 75 and 80 cents, okay, for the foreseeable future. So right now it's 70 or below, we're undervalued. And I would want to, if I'm taking a longer term view on things, tend to want to be more hedged at the moment. That's not talking about the next week, 2 weeks, 4 weeks, month or two, where there's more flight to safety into the US and the Canadian dollar weakens. But we're pretty darn close to a low in oil prices. That's a big factor for the Canadian dollar. I don't see a whole lot lower here, but really the support for the Canadian energy sector from our federal government today is atrocious. And I don't see the Canadian energy sector, while it will recover with oil prices, come back with vigor. I think until there's a lot more support, governmental support for Canada and the energy sector. So tilting towards more hedging at this point, Brett. The ECB orders banks to suspend their dividends a few days ago. UK banks doing the same. Does the Bank of Canada have the power to order the same thing in Canada? And do you think it's likely? The reason these other central banks are doing this is because they're providing lifelines and lending facilities to make the banks liquid. And to date, while the Bank of Canada has come in to support commercial paper and some investment grade corporate debt here in Canada, they haven't yet gone to the point where they've said they're putting out unlimited amount of repos to the Canadian banks for liquidity purposes. That may come. And if the banks have to go to the trough for support, there will be a strong political will for them to at least suspend dividends for a while. BNN in the last couple of days had a few of the CEOs of the banks on, and they have no business plans to cut dividends or suspend them. So things change. It's a great question, but it's fluid. I don't have a yes or no answer. I'm holding a sizable percentage of cash in my portfolio. I'm not comfortable sitting on Canadian dollars, waiting to invest. I believe the loonie will decline. So similar question here. You can buy US dollars. So if you're trading an account and you're paying 2% each way to buy and sell your FX, that's a problem for me. And I don't use a discount broker. I trade at institutional rates. I traded a couple pips off the spot rate, and that's for all the liquidity, like for billions, right? When we're trading. So I trade institute. If you're an individual trader and you're paying big currency spreads to buy and sell, you got to think about it, because I don't think the Canadian dollar is going a whole lot lower, but it is going a little bit lower. There are some ETFs you can buy. I think Horizons has one in Canadian dollars that actually gives you exposure to holding like US money market. And I don't have the ticker off of my my head, Bruce, but I believe if you went to the Horizons website, you'll see dollar index ETFs, and you can check on those. Bobby's asking about robotics and artificial intelligence, and that I mentioned them on my my shopping list. And so again, as I said, Bobby, my shopping list isn't coming out for a while. At a minimum, we're going to retest the lows. So maybe one tranche if we get back to the lows, quarter of what I might buy. The next tranche somewhere below 2,000. The next tranche closer to 1,700, that Fibonacci retracement area, and then the final tranche would be, you know, really extreme, where the economic impact is going to be so bad, but it's fluid. If we go by a month or two and our people are going back to work, we're not going to see those extreme levels. We might, but we're probably not. And the key thing there being probably is, okay? Okay, experience is that 3 days before our dividend pay date, every month the unit price drops and the dividend is paid with my own money. After several months, I checked my account with the dividend added and market value and had not made a red cent. Even lost a few dollars besides the I'm thinking you're talking about, Ken, here about ETFs. It wasn't clear in the question that I see here. If you're talking about individual stocks, when stocks go ex-dividend, you know, it will trade the next day at the value less what the dividend was paid on the X date. So that's normal. But when an ETF accumulates dividends, it gets built into the net asset value of the ETF as it stores that cash until the day it's committed to go ex-dividend and pay those dividends out. And then it will trade without a dividend. So here's what happens, Ken. Some investors don't want the dividend because they don't want certain tax treatment. They would prefer the capital tax treatment, which is better, capital gains. So what you tend to see sometimes is a group of people will sell a security or an ETF in front of a dividend and then put the money somewhere else. I don't know where, but somewhere else, and then buy it back after the dividend because they don't want that dividend. So that happens a little bit, but your comment here I don't think is valid. And I'm not sure specifically what you're talking about. So that's a little bit color for you, Ken, on the points there on your question. So with the advent of this coronavirus, the Canadian, never mind US governments are putting this country in debt, federally and provincially. while the probable tune of $500 billion as well upcoming flood of bankruptcies. So what does a retiree do with a modest amount of TSFA in order to obtain both an income and a possible gain? So I've given out a lot of ideas out tonight, Richard, as to where you might think about putting the money. But really, for the average person, the simplest thing to do is look at the Vanguard, the iShare, the BMO series of their very generic, balanced portfolios. And when you're concerned, you buy the ZCON or the VCON, which is the 40% equity, 60% bond. You can buy the 60-40, which is the BAL, ZBAL, or the growth, ZGRO, or the all equity, the VT, the Vanguard Total World ETF, if you want maximum upside gain. So we're in an era where governments have promised so much, and even more today, and they're never ever in my lifetime anyways going to be able to pay off or even pay down the debt. The tax base, the demographics just simply won't allow it. And interest rates are going to have to stay very, very low, with central banks monetizing a lot of the debt to just get us by. And that is the world we live in. But that's been the world for 10 years, and we've had rip-roaring stock markets. So Richard, there's always places to invest. You just got to do it with a bit of prudence. And buying a broad market index is just fine. Sean says, I have a portion of funds set aside in cash, which I'd like to put in the energy sector. How would you suggest I leg in? Well, the first tranche was a couple weeks ago, Sean. I had talked about on the BermansCall episode that week that I had recommended Suncor. Suncor, I believe, was the Cadillac. And I actually told my best friend to go buy some. And it rallied 25, 30% in a couple of days. I told him to sell it. And sure enough, it's even higher today. So, where's the bottom and how do you leg in? I think you do not want to speculate in the stocks that may go bankrupt, may not come back. This is going to be a very, very difficult market for energy for a long time, and specifically in Canada, with the lack of support from the federal government, and globally from the move to a lower carbon world. I believe it. I believe it's important. I believe we're moving in that direction. And I would suggest that you hedge some of that with an investment in ICLN, which is the Global Clean Energy ETF. So how do you leg in? You just pick your points. To me, I look at chart points. When crude oil hit $42, I said, wow, that's the bottom end of the range. And I bought some. I did. I bought some at 42. And then the day after, Russia says, listen, we're out. We're going to pump oil here. And then it went down to 30. And then they realized how bad COVID-19 is going to be for the world. And that 20 or 30 million barrels of oil, because nobody's driving cars or flying in airplanes for months, is going to come off the market. And then it went to 20. And at 20, I said, 20, boy, the Canadian oil was trading at $5 a barrel. It was cheaper than a cup of coffee. And now, of course, you can't drink crude oil, but you got to be able to store it and take delivery. So practically speaking, you need to use financial instruments, right? So crude oil ETFs, you can use them, but you got to understand how the futures market works. And so I'd been playing this basically by being long puts. I just covered those puts a little early and exposed myself to the long side of that trade. So I bought a put to be bearish, and I sold a put at the level I wanted to buy. And low 40s was that level. And so I lifted half of my long put. I took a profit on it, exposed myself to the bounce back, which never came, and it went lower. And then I lift the second leg of that put, and now I'm long the USO ETF in two of my portfolios for my clients. I don't do this in the BMO funds. And my average price is around 30 $31. So we got the pop today on the Trump tweet. And so what did I do? I sold forward half of my position at $31. I got a 5% yield for 2 weeks of an option premium. So those are some of the things I do, Sean. I'm not sure if you're going to be able to do some of those, but definitely you want to be legging in. Regarding the S&P 500 and VIX, you showed they have a similar relationship. Was it the same in 2001 and other bear markets? Well, the VIX index and VIX ETFs haven't been around that long. The VIX index itself was created in the mid 1990s, became popular in probably the late 1990s, and before that there weren't any. So we have proxies, and we can go back and look at what they might have been, but they didn't exist at the time. So really in 2001, and the answer is yes, we saw significant spikes in volatility for months and months and months, but that bear market played out over 3 years. The bear market in 08 and 09 really started when Lehman went under, but it had been in decay. So it was more of a slower market decline in 2008, the first half. And then once Lehman went bankrupt, that's when the volatility spiked up tremendously. So it's that shock that really pushes VIX above 40. VIX between 25 and 40 generally is the dip buying opportunity. But those, Robbie, are corrections of 10 to 20%, not the Papa Bears. Okay, David says, Larry, I'm considering the emerging market ARK FinTech Innovation ETF. I like that one. Has some good holdings. Yep, I agree. But the volume's low. It may be difficult to buy. So what's your opinion? So limit orders are must. Erica talked about this when trading thinly traded ETFs. You know, if you want to pay the spread, pay the spread. The more illiquid the underlying stocks are, the more liquid the ETF's going to be. When you have stocks or ETFs that have half their holdings trading in other places of the world that aren't open in North American hours, the market makers can't hedge if they have to issue new shares. Spreads are going to be wider. So Erica talked about some of those things, and you have to consider those. So I like the holding. I'm not buying it today, but it's something that I will look at when my shopping list comes out, 10 or 20% below where we are today. And Bob writes, I'd like to know your opinion on preferred shares close to retirement. There's two types of preferred shares. We have the perpetuals that trade more like bonds, and we have the resets that do really poorly when interest rates are falling. And so I'm not sure which ones you own in here, Bob, and you can't just say preferreds. What I would say is that Evolve ETFs today had a webinar, which I watched part of. I wasn't able to watch the whole thing. I watched part of it that talked about what they do in some of these actively managed bond and preferred type holdings. So I would go look at that. There's a lot of good information, but really buying and holding preferreds, you got to know what you're doing. And there's a lot of financial advisors that will recommend preferreds because people want yield. And there is yield there, but they're not without risk. And so without knowing more, Bob, I can't fully answer that question. And Frank asked here, can I explain what negative interest rates mean? Does it mean the government rates minus inflation? In other words, real rates are nominal. And if it's nominal, why would anyone invest in a negative interest rate bond instead of leaving the money in cash? Well, the reason you would buy a bond yielding negative 0.2 is because if you put your money in cash, it would cost you negative 0.5. And so there's always a yield curve. Now, in the institutional world, you've got to get a return on your money. So what they did in Europe was they put if you held cash in a custodian account, if I held cash in my mutual fund, which at one point I had some euros in, I was paying to hold that cash, Frank, 65 basis points. I was paying a negative yield of 0.65% over a year. But it was my expectation that holding those euros when the dollar versus the euro was trading at US dollar at 105 was that I was holding it because I thought the exchange rate would be 110 or 115 in the future. And so I didn't care about the negative yield. So there's a couple different aspects to that. The individual investor doesn't think that way, but the institution does. And so I'm happy, I'm not happy paying, but I'm okay paying if I can make money on the capital side. Okay, so that's a bit about that. But that's what the Federal Reserve and the Bank of Canada have basically said we don't want to go to those kind of policies. Okay, so I don't think we'll see that in North America. I think it's pretty clear the governments and the fiscal taps have been released in a big way, and we'll see more of that kind of stimulus versus negative interest rates from the central banks. And so that's all the questions there. Rob's asking about Suncor. I liked it at 15 or 16, so I commented a bit on that. Do I like it? What's up with that? So I mentioned at the time that I thought Suncor was the Cadillac, and most of their revenue was based on fracking and sales at the Petrocan stores, which is very true. And while the industry is going to be stressed, they're much able to get through it better. And what I thought would happen was that Suncor would end up buying a lot of these bankrupt assets that we're going to see all over Canada from some of these players who had a lot of debt on the books to finance. And when oil was $50 a barrel, they were making tons of money, no problem paying the debt. But with Western Canadian Select sub $10, they're all hurting, and they're hurting substantially. And so the companies with good balance sheets like Suncor and some of the other bigger players are going to pick up a lot of these guys on the cheap. So that's why I like Suncor. Would I buy it today? No, I wouldn't be chasing the strength here. I'd wait for a pullback. Almost certainly we're going to get more volatility in the world. But it seems pretty serious that we're much closer to a bottom there than anything else. Thoughts on MasterCard and Visa? I like them. I think they're going to be big parts of the world in the future. As we go to digital money, there'll be players there. So I'm okay with them. At these prices, again, across the board, whatever it is you're asking about, the answer is lower. So own a little bit now, with the understanding that it's probably going to go down more. And when it goes down more, you want to buy more. Where's the bottom going to be? I don't know, but we want to buy into the sell-off and whatever that is going to be. What range do you expect in trading for the next 3 or 4 months for VIX? We're going to stay elevated somewhere above 40. And what level, what number it is, I don't know. Good ETF with exposure to American technology stocks. Listen, the best one is the NASDAQ QQQ. You get a little healthcare in there and some biotech as well. If you want a pure technology play, large, mid, small cap, the iShare IYW gives you that broad exposure to all segments. The list I put up there is a list of technology plays globally in sectors that I like, and I would first have a look at some of those. And if you want to know what stocks they own, go to their websites and drill into the holdings list, and you can pick some stocks out of those baskets as well. Canadian pipelines. Listen, the reason I put most of our money in US pipelines is because the support for expansion in pipelines in Canada is a travesty. And I commented on the move to a greener economy and a greener world, and I'm all for that. And I'm putting solar panels on my roof, and I've got a battery-powered car, so I'm a believer, but not balancing the economic risk of devastating a whole industry is negligent, and I would use that word frankly when I talk about the Canadian government's policies regarding our energy sector. I'm not going to get into specific stocks here because I just don't dig deep enough. Thoughts on inverse ETFs for tactical. So I've used them in the past. I have no issues with them at all. I prefer option strategies to get my downside exposure. And that's the comment. I have no issues with using the Horizons single use without leverage ETFs. Kirkland Lake. I like gold. It's one of my favorite holdings. I talked about it today. I've been talking about it for a while. It's unfortunate that there's been a lot of selling in that sector. It's unfortunate that some of their mines are not producing right now and they're going to take some earnings hits. But the reality is the world we're heading into of debt monetization, where central banks are going to have to throw cash into the system, is going to cause some inflation down the road, and gold has a great runway in that world of low interest rates, ultimately inflation pressures and central bank monetization. What's the next news headline I would feel would trigger for a bear leg? It's nothing new, okay? Because everything that Cuomo said, everything's starting to tilt towards being a bit more positive. Cuomo's press conference today, the good news was, if I can try to repeat his accent, the good news was more people are being released and we're entering into hospitals, and that's all good. That's kind of the narrative. So, today's headline on unemployment. But I think the next series of these are what corporations are going to say about earnings, because that's going to smack the Wall Street analyst in the head. Now, most corporations, they don't know. They're going to tell us in their conference calls over the next month that they don't know. They have no visibility in earnings until this is all over. So really, it's all about when are we going to get through this period? And that's what really all the headlines are going to be about. Is there a way to invest in government debt that's being acquired? So while they in the U.S. they put out on the Treasury website, they put out a list of the bonds they're going to buy, but you're competing with the Treasury desks of all the banks in the world. So don't try to play that game. Which account would be best for ZZZD, TFSA, RSP, or regular taxable account? The distributions that come off ZZZD are part dividends, part capital gains, and part interest. So when we're hiding out in bonds, that distribution becomes interest. So that's the worst kind of tax. When we get a dividend from a foreign corporation, which is a huge part of the portfolio, it's not treated as a tax benefit dividend. Those dividends have to come from Canadian corporations. So from a capital gains perspective, which is we do a lot of moving around, that's a benefit. So registered is probably a bit better than taxable, because I don't focus on delivering an after-tax dividend. That's not what I'm focused on. Sleep at night dividends. You can't have both. And if you want the benefit of the dividend tax credit, it must come from a Canadian corporation. Okay, that's CRA's rules, not mine. I like gold as an inflation hedge. What other commodities will rise as well? Well, typically, if we're going to go into a demand period, which we're not for a long time, with robust economic growth, oil fits that bill pretty well. But here's what I think in terms of commodities for the next year or two, we're going to get a massive infrastructure spend. And copper and some of the base metals have been beaten up because of this. And that's going to be an area in addition to steel. So this infrastructure bill is going to fix bridges and hospitals and roads. And so those kind of commodities will come out of this leading. And so base metals, ETFs, XME, SLX, which is both of those are US based. BMO has ZMT, global base metal miners. Those are some of the ones I would look at for commodity plays coming out of this. What's the opinion on tech? There's a decent name there too, with the exception that they got some oil exposure. And I don't like the coal there, although it's coal for steel. It's still an industry that's on the move down. I see on Berman's call, I mentioned dividends will be cut and won't recover for a decade. Can I say any more? So the chart I put up there was of the Chicago Mercantile Exchange futures contracts based on the expectation of dividend payouts for the S&P 500 companies. So at the beginning of this year, the S&P 500 is trading at, say, 3,200, something like that. And the dividend payout by the end of the year was expected to be $61. So that's a dividend payout of around 2%. The current expectation on those futures contracts are for dividends to fall about 25%, maybe 35, in that range over the next year or two, as the companies that need support cut dividends, and the other companies that don't need support but are going to have hits to earnings are going to cut dividends. So those are the two areas over the next couple of years that are going to have the dividend impairment. But with the S&P, say at 2,000 and dividends at $40, not 60, you're still getting a payout of 2%. So those are a couple of things to think about there in that question. John, Jim asked, should you buy GDX, GLD, or both? And so both is the answer. If you want maximum leverage to an upside move in gold, you go to the companies that have more leverage to the upside, the juniors, GDXJ. But they're also going to have 2 to 3 times the volatility of gold bullion. So I would say, Jim, you have to make the call. I own parts of both, and I understand how to use them and when to use them. And so one of the things I do is when gold sells off, when bullion sells off, when gold stocks get pounded, I sell some of my bullion and I replace it with GDX. I sell GLD, I buy GDX. When we rally up to resistance and I still want to be there, I sell some GDX and I buy back my GLD. So I still have exposure to the sector, and if it keeps going higher, I'm still making money. And so that's a risk management thing. Jim, that's a sleep at night thing too, because it's going to help reduce the overall volatility of your holdings. If you go all pig on the gold stocks and juniors, and you go through a period like we just went through, you're far more likely to be shaken out when those things fall 50%. We were trading at 30, 31 at the recent high on GDX, and it intraday traded below 15. And if you have the intestinal fortitude to stick through that, then by all means, trade the juniors. but I don't know that by asking your question, John. So we got 1 or 2 minutes left. That's enough questions. I'd love to get to all of them, but tune in next week, guys. I'm going to get to as many questions as possible. Finally, here I do want to remind you of our partner companies and our charities. So you will get an email. The email will share with you some ways to engage with us, and whether that, if you're looking to buy one of the BMO portfolios in ZZZ portfolios I talked about tonight, you can go buy them the ETF version, or the discount, buy the D-class version. They have the same low EMERs as the ETFs. If you have portfolios of $1 million plus or have aspirations to get there, please give us a call and ask us about our private client portfolios, where we use option strategies and more sophisticated things than we can do in the ETF world only. If you are interested in financial planning, folks, we have the best financial planner in Canada, I think. She's wonderful to deal with, Monique Madden, at our company called U Potential. It's fee for plan. You don't have to do business with us, but she will help you understand what your next 5, 10, and 25 years looks like when you're thinking about the retirement picture. It's worth spending a few $1,000s to get that understanding. It would also help you understanding how much risk you need to take in your portfolios. For the women out there who are watching, and some men too, our Golden Girl Finance portal is all about trying to speak to women about finance. And guys out there, we know the women really control the pocketbooks, so maybe have your better halves there, have a look at that website, and you can have a look at it too. And for the investment advisors that are out there on the call, our portfolio manager platform is something that you might want to have a peek at as well. Please, if you've enjoyed the calls, if you like Berman's Call, if you like what we're doing for you on investor education, please, 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 $20, $50, $100. Someone actually gave $500 donation. Thank you very much to help the kids with cancer at Sick Kids Hospital, dementia and Alzheimer's research at the Baycrest Hospital and Foundation. Some of the world leaders here, folks. I know times are tough, but give if you can. Thank you very much, everybody. The presentation will be available on replay.